In this episode of Bite-Size Finance, I'll be going over what actually makes the stock price go up and down. Let's say you are a tech startup and you are looking to raise funds for future development by selling stocks of your company to the general public. What you would do is go to an investment bank such as Goldman Sachs, and they will send in a bunch of people to gauge investor interest in your company and come up with an initial public offering price based on the valuation of your company and assessment of similar companies in the past. This is also known as the IPO price, and this is how the initial price of a stock is set. Now, why would an investment bank do this? It's because they would get a nice commission out of this. Often they would charge around 7% commission of the amount raised from the initial public offering. So if the IPO raised $10 million, they would get $700,000 in commission, which is not too bad for a couple months of work. Now that we have the initial price for a stock, the fluctuations in the day-to-day stock price is determined by supply and demand. At any given time, there are three prices for a stock. There is the bid price, which is the highest amount that someone is willing to pay for the stock, and an ask price, which is the lowest amount that someone is willing to sell a stock, and the current price, which is the price of the last completed transaction for a stock. The difference between the bid and the ask price is also known as the spread. Normally, it's good for the stock price to have a smaller spread, since it would mean that people mostly agree on how much the stock is worth. Let's say the current stock price of a company is $100, and there are three bid prices of $99, $98, and $97, and three ask price of $101, $102, and $103. Suddenly, bad news breaks out, and there's some Ebola infection at this company, and everyone wants to get rid of stocks from this company. So Dave comes in and says, look, I am willing to sell the stock at a price of $99. The bid order at $99 gets filled, and the current price changes to $99. Now, Sarah comes in and says, the news is bad, and I want to sell my stock as well, and I am willing to sell at $98. So this lowers the current price even further to $98. The opposite would happen if there is a lot of demand for the company stock, which would serve to drive up the stock price. To sum up, the initial public offering determines the initial price of the stock, whereas supply and demand determines the day-to-day price of the stock. If you have any further questions, leave them in the comments down below, and I will see you in the next one.